impression is that future generations will look back on this moment and say, this is where they completely lost their minds. On that note, welcome to our Zoom web series hosted by One Tree Hill and PMS Card. This is on the Juggernauts on conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Prashant Trivedi, who is the CIO at MultiAct Investments. Welcome Prashant to our show.
Thank you, Jai.
One of the things that we like to, just dive immediately into is what we call the Machine Gun 15. We have a lot of fun during this round, and hopefully, you'll have a lot of fun as well. So if you're ready, I can start shooting off questions.
Yeah, fire away.
Okay, perfect. Do you think India will see a ratings downgrade anytime soon?
Well, I think that's why the government hasn't actually opened up the fiscal spigot. So I think a lot of commentary has come in about, well, why isn't the government doing more? And the fact is, I think some of the economists have pointed out that India doesn't issue a currency which is accepted as money all over the world, and so they have to be a bit careful about how much they actually take that fiscal deficit higher. Short answer, I think we're going to manage to avoid a ratings down.
Okay. Do you think oil will go back to zero in any future contract for the next year?
I don't think so. I think that particular instance was a very unusual one. And I think, obviously, some of your readers may or may not have known that the reason was entirely because the storage in Cushing was absolutely full. And so what it is was that the oil contract, when you take delivery of it, you have to actually store it in Cushing. And that storage was completely full. And so a lot of retail investors who bought the USO without understanding how the USO ETF actually works ended up being caught on the wrong side of that. In fact, a lot of them didn't understand that the USO ETF doesn't give you a like-for-like play on oil. So I think, people are aware about it. I would think that USO itself will actually roll over contracts far more in the future.
No, I think definitely. I think as soon as, people start seeing oil going to negative, I'm pretty sure people called you up and most of the advisors are like, how do I buy oil and store it, right?
Yeah, that's right. And without understanding that was the issue, storage was the issue. So I don't know whether you've been following, but the more interesting story from an investment angle is, all the VLCC carriers. And just to give you a very brief snippet, VLCC rates, daily rates have gone from 30,000 to 150,000.
Wow, really?
Yeah. And so these tanker companies, the guys who got these VLCC,
right.
In some cases, they're going to get almost their entire, cost of a VLCC within the next 2 years or so.
Sure.
In some cases, less than 2 years. Yeah.
Wow. So storage still seems to be an issue, right?
Sorry?
Storage still seems to be an issue.
Yeah, storage is an issue, and the reason is really the contango, right? So what it is that the spot prices are very low, but the further out months are much higher. And so it actually makes sense for you to buy spot, store it, and then sell it, in the further out months or further out years.
Right.
And so if you do that, then obviously you can, recover the cost of the storage per se. So that's why we've actually got the storage full, because everyone's looking to buy on spot, store it, and then sell it in the future.
Sure. Fair enough. Would you rather be simplify your trading principles, or would you diversify your trading principles or investing principles?
No, I think all these sort of events where, let's say, with the best will in the world, you still end up getting blindsided.
Okay.
is a great opportunity to simplify things.
Okay.
And that's exactly what we're doing. We're trying to simplify our principles, simplify our portfolios. I think one of the things that people don't realize is that, when you want to control risk, the simpler the line items, the fewer the line items in your portfolio, the better it is for you to actually understand what are the myriad risks. If you have a very complicated portfolio in terms of too many line items, you just will not understand, the risks particularly in an environment like this. So yeah, absolutely. No question. Simplify.
Simplify. Okay, so I'm going to put you a bit of a spot. Would you say passive or active, or is there a balance between both the styles?
Well, I mean, I think we've always been active managers, and the reason is that if there was a widely there's a widely circulated study which has actually been corroborated that if you look at how many securities, and so in a world of 47,000 securities, equity securities, how many securities have actually contributed to increases in market capitalization? You'll find that it's no more than 4% of the securities. So
Wow.
that tells you 96% of the securities essentially, disappear. They don't contribute to increases in market capitalization. They come at very high IPO prices, so most of the investors actually lose money, and/or they effectively, lose money for investors over a long period of time. So we've been very much active managers, and as our mantra is looking at risk from a completely different point of view, not modern portfolio theory. We look at balance sheet risk, we look at market risk, and so we look at risk from that angle rather than some sort of a top-down beta or whatever kind of risk factor or value at risk or whatever it is. And so we very much believe in active management, and we think that something like this is actually going to bring active management back. May not happen straight away, but it will definitely happen over the course of 1 to 3 years.
Okay. Prashant, you've always been a global investor, and from the startup point of view, do you see a boom or a bust in the next couple of years?
For startups?
Yeah.
No, I think we actually also, by the way, invest in fintech startups. So we have an AIF piece that we invest in fintech startups. Sure. And I actually think that, if anything, this actually is going to hasten digitization. So I think some of the trends that we saw even before COVID actually hit are going to actually happen much faster. So from that point of view, I see, a faster move towards digitization, contact-free, stuff, and sort of, all those kind of factors. The only thing I would say is that I think the environment for investing in startups is even better because a lot of the kind of silly money that was flowing around isn't going to be around. And I think startups have a great responsibility to show how their business models are going to be successful and meet an endpoint, which is returns to shareholders.
Absolutely. And finally make money and not burn all the money.
Yeah, exactly.
Fair enough.
Exactly. No longer a model of well, show me how much money you can lose, I'll give you more money.
Great. Would you sacrifice sort of investment performance first or your investment principles?
No, I mean, I think I'm very, very clear about that. I think investment performance can only be built on investment principles. And so we would never sacrifice investment principles for what we think may perform better in the short term. And, I'll tell you an interesting story. So one of the people that I'm sort of proud to call my mentor is a great value investor and an Austrian economist or an Austrian economic perspective called Jean-Marie Eviat. I honestly think he's one of the greatest investors around. And I was having dinner with him once, and I said, what really impressed me. I told him, I said, what really impressed me was that you were prepared to lose 2/3 of your investors rather than sacrifice your principles, and chase the tech boom. And I said, that was really, that's what really impressed me. I said, how did you have the courage for that? And he said, well, look, it wasn't as complicated as you make it sound. It's just that I live and die by my investment principles, and I just didn't understand what was going on. And I said, well, look, this is the only thing I know, and I'm going to stick with it. And sure enough, it paid off for him in spades. Today, I would think that First Eagle funds have easily got about 100 times more AUMs than they had that they
Right.
lost.
Sure. Fair enough. Over your experience, and this question keeps coming up, what is that one mistake that investors keep making across decades, or a misconception that investors have about the markets in general?
Well, I would say the big mistake that investors make, and I would say value investors in particular make, is that they think mean reversion works in every single instance.
Sure.
And we know from history that things don't necessarily mean revert, right? That there are, in 30% of the cases, or 20% of the cases, or whatever number you want to pluck, instruments won't mean revert. That there will be structural changes which, any value investor who believes in mean reversion will sort of, in the first instance, say that, oh yeah, listen, this is the market just taking a very, very negative and pessimistic view, and this is not going to happen. And we know, that look, these things, you do have structural changes, and these structural changes actually can really hit you. The second thing I would say, which is very, very interesting and important, and is an insight that I guess comes from learning the hard way, which is that value investors always think that well, what's my downside, and maybe my downside is book value, and or even worst case scenario, half of book value or whatever, tangible book value, right? And what we find in the modern world is that it doesn't work that way. That the managers who control that particular entity will never, like let's say in Graham's time, actually liquidate the business and hand over the money to the shareholders, right? They will never do that. They will literally ride that secular bust, or that secular change, all the way down to zero. And so you're effectively in a value trap. And if you think that you've got any kind of absolute measure, which will be a bedrock on which you can hang your hat and say, okay, half times tangible book value, or this or that or whatever, it just doesn't work that way. Management would rather take that company down to zero in the attempt of trying to turn it around than liquidate and hand over the money back to shareholders.
Sure. So on that thought, would you double down or double up?
No, we don't believe in doubling down. I mean, we do have a situation where we say, okay, you get two bites of the cherry. So you can buy one stock, and then you can buy the same thing again once, but you're never allowed to buy it, the third time.
Okay.
And that's absolutely the the sort of one of the investment principles that we have. And I think that's a big mistake value investors make. I heard one value investor who should remain nameless, who in a very important conference, he's a very famous guy, was asked, when do you know you're wrong? And he says, well, when the stock goes to zero. And and he said, I'll keep on buying because my principle is that lowest cost wins. And I think that's just a very, very I would say a very, very arrogant approach to investing. I know value investors anyway have that little bit of arrogance about them, in the sense that they always think that, well, I know more than the market. Otherwise, why would they be buying a stock which is actually out of favor, right? But I think doubling down repeatedly is actually the height of arrogance, and I hope never to do it.
Okay, fair enough. You also mentioned that you guys are looking at fintech investments, and a big portion of fintech investments is credit, right? And for the next 6 months to a year, or for the next couple of years, do you see a credit contraction or a credit expansion?
Well, interestingly, that's the one area we're trying to avoid. So in all our fintech investments, we are actually avoiding credit. What we are trying to focus on is really non-credit based fintech kind of investments. So what we are focusing on is, fintech investments that bring artificial intelligence, to corporates who are taking decisions. Fintech investments where you're helping investors make smarter decisions about investments. That kind of stuff. So we are actually trying to avoid fintech investments, that extend credit. But having said that, we do have a very small investment in a credit fintech. The only difference is that they are specialized asset-based lenders. One of my sort of very important points about credit is that actually credit should be extended in specialized asset managers who are actually digital. And the reason is that if you're a specialized asset manager and you're digital, you can actually gravitate towards a situation where you're virtually creating a mini exchange. So if you can create a mini exchange so that, let's say one guy has got a credit issue, but someone else actually needs that piece of equipment, you can actually, take it from that guy who's got a problem for whatever reason and put it in and place it with a guy who actually needs it, right? And who may not have the same issues in a different local market or whatever. So I think, the transference of specialized credit to digital platforms is how I think the world of credit will actually evolve it. And I think you'll have a special advantage if you can actually do that.
Right. And I think there are a couple of guys who are trying to get onto the debt exchange side where they're trying to be a marketplace. Definitely a space to watch out for.
Yeah.
Great, Prashant. I think, you've come out with flying colors for sure. And, your hamper should be reaching you as soon as this lockdown ends. And, talking on the lockdown, where do you see, lockdown with respect to cities like Bombay, expanded to tier 2 cities and India as a whole? And how do we come out of this?
Well, I think this is a very difficult question, and I'm sure the Prime Minister, has 1.3 billion armchair. He has 1.3 billion armchair commentators who are all saying that I know better than you do. And I think it's a very, very difficult problem because it's a very fine balancing act between endangering people's lives or endangering the economy. I don't want to sort of try and be yet another armchair theorist about it and give advice to the Prime Minister. I'm sure he's got the best people advising him, and he's using his judgment to the best of his ability. But I think it's a difficult problem. But obviously, I think one of the ways that they have, which is opening up those areas, and India is a very, very big big country, and sometimes we fail to understand that really we are 23 countries in one, and so I think some of the ways that they've come about, which is opening up these areas which don't have cases, albeit it's a very improper way, because yes, I mean, we're going to have situations where supply chains are not yet open, dealerships are not completely open in every single area, and so we have all those sort of issues. But I think they've given themselves a fighting chance now of knowing where all the active cases are. I mean, I think we've been virtually in about 40 days of lockdown. There was a paper that suggested that 49 days you could actually avoid a second wave, and you could avoid a big surge. So I think we, by the time this is over, we're going to come close to that 49 days or whatever. And I think my understanding is that they know where the cases are, and if they know where the cases are, and there is actually very active monitoring, right, there's a good chance that we'll escape the worst of what Europe or the US have experienced.
Okay, that's good to know. I'm not going to push you more on your opinion, but sort of moving on to your organization at MultiAct. I think clearly with the track record that you'll have, it's evident that you'll have been great risk manager, right? And chasing, reduction in risk rather than much higher returns. What do you think has been your sort of edge and USP that has contributed to this success?
Well, I think, firstly, we've always sort of looked at, we've always looked at the, risk from the trinity of risks, the way Graham saw it, right? So, we insist on, on understanding balance sheet risk. So generally speaking, we prefer to have net cash businesses. Today, about 75% of our businesses are net cash businesses, as opposed to, let's say, the index, where just 50% are net cash businesses. So that's a key component of it. Secondly, we look at profitability. So again, all the businesses that we have Their underlying returns are far higher than the benchmark. And these are sustainable businesses. So we look at business models in terms of whether they have barriers to entry, or if not barriers to entry. And third is we look at market risk. So there's always the risk that you pay too high a price. And generally what we try and ensure, through our valuation exercises, and as you know, we have a dedicated research team of about 25 investment professionals. We don't rely on sell side research except for very few, inputs, where we don't normally get those inputs. We rely on understanding, financial statements inside out. And so I think, all these things in a way incrementally contribute to the fact that, on the whole, we've tended to have far lower drawdowns than, let's say, the market indices have had. Having said that, we were, as you know, Jay, we were anticipating something like this even before, and we thought we were reasonably well positioned for it. But no one anticipated that you would have one factor which would affect literally every single business. And so it didn't matter, how you were positioned in the portfolio. And the other thing that didn't matter was actually also the fact that everything was on sale. So, in February and March, the margin clerks took over, and it really didn't matter, what stock you held or whatever. The margin clerks just had to get rid of everything.
Right.
And so I think that, that leaving aside that particular, situation, what I expect over the next year, and especially the next 39 months, is that the markets will actually start discriminating between those companies that have the cash to survive. They have the competitive position that will actually end up becoming even stronger, that have the, that are in industries which will become even more relevant going down the road. And so that's essentially what we are trying to do now, is to make sure that we are invested only in the dominant player within industries that continue to remain relevant.
Sure. And as you mentioned, Prashant, these are definitely trying times, right? For every participant in our ecosystem. Has there been time when you've looked back and said that, look, I needed to adjust my style, my process, or to make those few adjustments to your entire gamut of investment thesis?
Jay, I would say we are always trying to improve. So I think, what I'm trying to inculcate in the MultiAct DNA is that every day we should learn something incrementally new and actually try and be incrementally better. Because I think truly dramatic changes don't happen overnight in organizations. They happen because every day, every single guy, every single team is thinking about, well, how can I do my job better than I did yesterday? And so that's the kind of organization I'm trying to, and I'm glad to say that a lot of my colleagues have actually risen up to that sort of challenge. We are looking to improve our processes every day, without fail, and so we're always, we're always doing things where we kind of, incrementally are trying to become better. And, I would say that, what I'm trying to inculcate in everyone is a tremendous sense of curiosity, because I think curiosity is what allows you to keep thinking that, okay, look, I can do this better. I can find something, outside of what I know today that, will allow me to do this better. So I wouldn't say that, we do it, and because, well, COVID happened and therefore, we're going to do it, these tweaks. We kind of attempt to do it every day. And obviously something like COVID makes you accelerate it. It also gives you the time to accelerate it, right? Because, you're sitting in lockdown and you're saying, well, you've got a million thoughts in your head and saying, okay, well, how do I get everything done as quickly as I can?
No, I completely agree. And, on being curious, back in 2004, at least when I started, I made the biggest mistake probably of my life, and I lost close to, sort of 6-7 months of my salary in one leveraged commodity play, right? Obviously didn't understand enough to do it, but greed took over. But has there been that one event or that one trade or that one stock which you would consider yourself, to have paid a significant tuition fee?
Yeah, well, I mean, see, I've been investing, in the global markets since more than 30 years.
Sure.
And I started out in actually leveraged forex trading.
Okay.
And it's quite interesting you know that the event which really sort of was a bit of a tuition fee for me. Thankfully, I didn't actually lose anything.
Okay.
But there was a substantial amount of volatility which virtually gave me a kind of a near heart attack. Was the unraveling of the ERM. And that's what and that's what I'm sort of I think that's what I alluded to, is that once in a while you get these non-mean reversion situations where let's say sterling, which you think, okay, you take any standard deviation and stuff like that, you'll say, well, this is the standard deviation, it can't go beyond this. And
Right.
suddenly you find that the euro or sterling fell 20 big figures in 1 or 2 days. And so that's a substantial change in terms of the regime that you're used to. So that was very definitely
Okay.
a tuition fee for me. And obviously in forex, when you want to make the returns, you're leveraged.
Right.
And it was a good thing that I didn't really damage my equity that much. But what it actually did was it accelerated my move into equities, because what I then sort of said, well, let me find some other area where you get enough volatility and you don't need to take on leverage in order to earn attractive returns. And so that actually kind of hastened my my self-study into equities and being fascinated by equities.
Sure. And to take this on the complete opposite side, what was that one opportunity that was quite obvious to you, or still is maybe, which the market is missing out on?
Well, I think, Jay, again, my view on gold, and I would say that it's actually gold. So I kind of, what happened was that in 2000, I was very negative. So all the models that we did suggested that everything tech was at least 6 standard deviations or 2 standard deviations on the upside, and everything non-tech was minus 2 standard deviations on the downside. And so that was a very easy and obvious strategic trade. And I'm glad to say that we did exceptionally well out of that trade. But what then started bothering me was that when I started seeing that the Federal Reserve brought interest rates down, and that time, believe it or not, they brought interest rates down to the phenomenal amount of 1%, from 3%, right? And so when they brought those interest rates down, it just struck me that there has to be something wrong. It can't be that the Fed brings interest rates down and hey presto, everything turns hunky dory again. And so I went very deeply into understanding the Austrian economic perspective, Austrian business cycle theory in particular, but other concepts like commodity money and why you need a commodity money, and the funding pool and things like that. And so then I developed that, I thought gold was going to rise tremendously. And of course it did, because from sort of 2003 onwards, it went up all the way to 2011. And then we had a bit of a setback, actually quite a big setback. But I think it's just it's one of those ordinary setbacks in a long road. And I think the closest analogy to the kind of world we are living in today is the Mississippi bubble. So if you read about the Mississippi bubble, John Law and the Mississippi bubble, that's the kind of world we live in today, with a reserve money, or a kind of a reserve currency for the world, which honestly, in my opinion, cannot possibly function in the long term as a continuing reserve money. And so I think at some point in time, gold will come back very strongly. And I think if you look at it, if you look at every single chart and you just divide it by the price of gold, you will see that we are actually in a deflation environment ever since 2011. Just about every single chart shows you that we are deflating against gold, actually from 2000, not 2011. That even 2020, the highs that we saw in nominal terms was actually a lower high denominated,
Sure.
So yeah, I would say gold is
Okay. So I'm guessing you're still holding on to that view. from a longer term perspective.
Yeah, from a longer term perspective, absolutely. Yeah. I mean, I think, family offices, think in multi-generational terms. And if you start thinking in multi-generational terms, then you realize that actually you shouldn't be calculating your net worth in whatever is the local currency. You should be calculating your net worth in, at the end of the year, you should divide it by, well, how many ounces of gold can I buy, or how many kgs of gold can I buy?
That's great to hear, Prashant. We are already at the almost at the end of this conversation, Prashant. You come obviously with a good deal of experience across multi-asset classes. But there have been times when, what would you say to a fund manager who's probably just started off in the last 2 quarters or in the last quarter, right? And put in the world of volatility, has probably taken on external money and is wondering what to do next.
That's a that's a tough one, Jay, because you can't collapse experience. You can try and collapse experience as much as you can, but eventually you need to go through, your journey in a particular way, and then temperamentally, you'll find what's the right way of dealing with it, and you can't have sort of one answer that answers it for everyone. But I would say, I would say the most important thing is be skeptical. It's very, very important to be skeptical, especially what you're reading about, perceived wisdom, especially wisdom in the press. It amazes me how many people lap up, the stories in the press as to why the market went down or why the market went up, and they actually believe it. I remember in 2003, 2007, when India had that really great run, where on our measures, it went from literally, lower limit all the way up to, upper limit, in the space of just 4 years or 5 years. A lot of people absolutely believe that, yeah, this was because, this is India's future and India's, arrived and all this kind of stuff. Without understanding that, look, all of this emanated out of an exceptionally loose fiscal, exceptionally loose monetary policy in the US, which literally leaked out into the rest of the world in commodities. And again, there was another story that, we're going to have peak oil, we're going to have, and now, you have a negative oil price, right? I'm sure you remember all about peak oil. I still have a folder in my, I still have a folder in my email about peak oil. I think I would say that one has to be very skeptical. And the second thing I would say is that read. I think Buffett and Gates and all these sort of great guys have told us that, look, there's no shortcut to read. Look at read about everything you can about successful people who've done fund management successfully. See if there are any principles that appeal to you temperamentally. But you'll have to come up with your own way. I started out being a great fan of Buffett, but Buffett and I have a disagreement about gold. He thinks gold is a barbarous relic. I don't think that's the case. So I would say that read about all the successful managers, try and absorb the principles that that make sense to you temperamentally, okay, and chart your own way. Okay. It's we have a wonderful tradition in India of this Guru Shishya Parampara. And I would say that try and get the mentor who makes sense to
you. Okay, superb. Prashant, thank you so much for your time. It's been I'm really thankful that it's been a great learning experience, and I picked up a few things that in this conversation. Is there something that you would like to add?
Not really, Jay. I think what I would advise. Obviously a lot of investors who are invested, they're dealing with a situation they never have. A lot of them are probably new investors. A lot of the old seasoned investors have never seen something like this happen. I would say that, look, there are three things that I do believe. Firstly, don't sell human ingenuity short. What I mean by that is that, I think we've got an incredible number of scientists all over the world. I can't remember what the number was. I don't know whether it's 2 million or 20 million or some factor like that. We've got an incredible number of scientists who are working to try and find a way to deal with it. We will find a way to deal with this situation. Whether it's around, not around, we find a vaccine, don't find a vaccine. We don't know the answers to that today, but we will find a way to deal with it. And I think there's going to be a whole bunch of incremental things that we'll find a way to deal with. So the first thing I would say is that we will find a way to deal with it. We've survived the Spanish flu when we had far fewer resources. The second thing I would say is that at the same time, investors should ensure that their fund managers stick to high quality equities, whether it is local, global. I think every Indian should have at least 5 to 10% of their assets diversified globally, to the extent that they're allowed by the regulations. I think that you should make sure that as much as possible across all the asset classes, you're invested in the highest quality spectrum of each of those asset classes. I think the key thing is, if the central bankers have succeeded in one particular thing, it's that they've really obscured the true credit risk in our economy. And I think so. If you stick to the highest quality end of each of the asset classes, you should actually do well at the end of this whole thing.
Perfect. Prashant, here's wishing you and your team at MultiAct a fabulous 2020. Even though, as you said, might not look that way right now, but I truly believe there is light at the end of the tunnel and it's coming soon. But again, thank you so much for your time and look forward to our interactions again.
Yeah, no, thank you very much, Jay. And, we wish you and PMS Card all the very best. I hope you're able to do what you set out to do. In fact, I'm sure you will be able to do what you set out to do, which is, bring a lot of light to the sort of dark corners of the PMS world. And so that's really excellent.
Perfect. Thank you so much, Prashant.
Thanks.